I'm Kim Coghill with ACA International in the Washington, D.C. office. ACA is the leading voice for the accounts receivable management industry. The content provided in this podcast is presented for educational and general reference purposes only. The content is not intended to serve as legal advice. Before we get started on today's podcast titled Debt Buying, Thinking About Today's Market, I want to remind everyone that ACA does have a deep dive webinar series on the CFPB rulemaking. It's available on our website at www.acainternational.org under the Education tab. So back to today's podcast. We have with us, most of you know Mike Ginsberg. He is an ACA member who is also president and CEO of Kaulkin Ginsberg. And then his guest today is going to be Mike Chiodo. He is the managing member of AMG Funding. So at this time, I'll turn it over to Mr. Ginsberg.
Kim, thank you very much. I also want to thank Alex and the ACA for hosting this podcast. We're very excited to be here today. Mike Chiodo is an expert in the debt buying space. We're thrilled to have him with us. We've expanded our service offerings to include debt buying, so we're very bullish on the debt buying marketplace right now. And there's really an underlying reason for that. As everybody knows, painstakingly so, the Great Recession hit the ARM industry square in the jaw. For a lot of debt buyers and collection agencies servicing banks, they found that the market really tanked. Many banks just stopped originating new loans. Those who did continue to originate did so extremely conservatively, area that we have never seen before. What followed was a tremendous drop-off in delinquencies, resulting in significant reductions in placement volumes for agencies who service debt, and for debt sales overall. Marketplace really dropped considerably. Let's fast forward 10 years where we are today. Banks today are originating at levels that existed before the Great Recession. Delinquencies are back up where they should be. We're also seeing that ARM companies have really learned to operate in a heavily compliant marketplace, and the economic conditions are extremely strong. People are working, confidence levels are high, people are borrowing at significant levels once again. So conditions are strong. That's why we're really bullish on this marketplace. Mike, can you talk just for a couple minutes? Let's have a conversation here about what's different today than 10 years ago in the debt buying market.
Sure, not a problem. Thanks, Mike, for having me as your guest today. I certainly appreciate it. Good to be working with you again. The way I see, how the debt market has evolved, especially over the last 10 years, be a little bit surprising for some people to hear, but the advent of the CFPB coming in, I think what it does is it actually helps those groups that are out there that are doing things the right way. Pre-10 years ago, that it was a lot easier for people to just get into the debt buying space. It's going to be a little bit harder. I think it is better for us as an entire group as debt buyers. I think that what we have is a great time based on we've got very high consumer confidence in the U.S. That combined with a growing housing market, got historically low unemployment rates. What we're also seeing is the access to capital for both larger and smaller debt buyers is a little bit easier to get and a lot more favorable terms. Those would be pretty much the highlights of why I see that today being better than 10 years ago.
I agree with you more. I'm just going to add one other component to this. When we existed just a decade ago, or even more recently than that, the vast majority of accounts and most buyers exclusively purchase credit cards. Today, we're actually seeing a broader market, as you know, and that certainly includes financial services, credit unions as well. Credit unions kind of filled the gap, so to speak, from that time where the loan originations from the major financial institutions dropped. Credit unions really started growing, and they're servicing the middle market very successfully, which adds activity here but also if you think about auto deficiency and even new markets that we started talking about, like fintech, we think that there's a new growth area as well as the previously existing marketplace. We can't ignore even healthcare. Healthcare has matured pretty significantly, and those companies that have focused in on healthcare receivables are seeing more opportunities to purchase today. Mike, do you think the banks are actually selling to small buyers or only the big boys?
I think that the banks are only going to sell to the small buyers is if those small buyers are super retail niche buyers, somebody that buys a specific segment of a portfolio or a specific population or something that has to do with that criteria that makes it so great for that particular buyer that they're willing to pay a multiple more than others. Other than that, most banks really are not going to sell to a small buyer. In the marketplace, you have a lot of competition out there. You've got a good amount of the large buyers that are heavily capitalized that can actually go to the large banks. One thing that the large banks don't want to do is they don't want to expend too many resources actually having an entire post-sale support team. That would be groups that would need to forward direct payments, take care of bankruptcy notifications. The big banks are really going to sell to the big guys that have the capital, mostly the publics and the institutionally funded. But if you're a small buyer and you're a niche buyer, some opportunity for you if you can just get in front of the bank and make your case.
Would an example of that be like a BK buyer or a bankruptcy buyer?
Yeah, that would be perfect scenario. You've got big sellers out there, and a lot of times, if you think about it, the big buyers, when they're buying it, they're actually going to, they can either resell their bankruptcies or they're going to take it to 2 or 3 industry experts out there that specifically service bankruptcy. So for those particular groups, that would be a niche, and it would make it a lot easier for the big banks because it would pretty much mitigate them having to be an intermediary with a couple hundred bankruptcy trustees you have out there.
So I'm a new buyer. Let's talk about what I need to do to become a successful buyer. Am I better off piggybacking off of these large buyers, paying a premium for the segmented portfolio if they're truly willing to divest, or am I better off buying direct and going and setting my sights smaller to maybe some of these credit unions? What do you think about the new buyers? What areas do you think are most attractive, and also how can we avoid some of these pitfalls?
Those are great questions. I think that, if you're a small buyer, the great opportunity is to piggyback off of a larger buyer. The biggest issue you have there is you just need to make sure that buyer has the authority to resell the portfolio that would be granted to him through the purchase and sale agreement with the original seller. If he does, it gives you, as the smaller buyer, an opportunity to kind of dip your toe in the water, not put as much resources out there as opposed to putting all of your eggs in one basket. If you are a buyer that is also a servicer / collection agency or operator of an attorney network, if you have the expertise, you can actually go and know that you have the historical data to really support your valuation, your liquidation, and your liquidation strategy. Both scenarios can work. It's really just a matter of timing, skill set, and having the right opportunity and capital structure to be able to either go out there and take down a portfolio on your own. A lot of times it is good to piggyback, specifically if you have a relationship with that bigger buyer where you're actually sharing some information, you're sharing some batch tracks, and you can each learn from one another. We have seen in the last 10 years, the fintech has now matured a lot. And then 10 years ago, when they first came out, it was pretty much 90% of it all online. If you had any type of job or anything, you would be able to actually go and get a loan through a fintech company. What we've seen now is that they're now kind of falling under the purview of more and more legislative bodies. What we see is that with fintech, you have to know your customer. So what's happening is the legislators are making sure that the fintech companies are not just going out and loaning money to anyone who can sign an application. They want to make sure that you have vetted your consumer and you know that with everything you've been provided, they can actually pay back that obligation to you. 10, 12 years ago, we didn't see that, and I think that that's why a lot of the larger fintech companies were experiencing 30 and 40% charge-offs, within 6 months, and many first pay defaults.
It's funny, specifically with regard to the fintech market, it almost mirrors the characteristics of the banks, say, 20 years ago in the credit card market, right? And as you look at it today, those buyers who are compliant, have technology sophistication, have knowledge and experience, can leverage those capabilities. But add to it that our analysis is pretty interesting. The fintech market, potentially very disruptive to the large and mid-sized financial institutions, number one. Number two, they're different companies. And that's very cool because that creates a new asset class. But number three, a lot of them, what they're doing, especially the big boys, are luring away the experienced recovery managers, portfolio sales guys from the large financial institutions. So many buyers have a leg up because they have established relationships with these individuals, and they can leverage those relationships. They move over to these new technology-oriented financial service firms. So it's an interesting time in the marketplace. For me also, and I think we need to mention this, because most ACA members are small and mid-sized, debt collection, whether they're first party or third party, whether they're in healthcare or in utility. Our biggest recommendation is a simple one. Experiment with the marketplace. Meet with your clients. If your clients are thinking about selling a portfolio, there's a strong likelihood you might lose that business. Or you might be servicing the debt buyer at a substantially lower rate, or different credentials, or something is going to change. Better to say to the client, hey, if you're thinking about selling a portfolio because you have cash flow needs, call us first. We know the asset. We understand it. We've serviced it before, and we have resources we have an interest in buying. And then you can leverage, an existing firm that buys debt or an advisory firm that can assist you. You could go ahead, purchase that portfolio, and service the accounts through your own operation. Mike, let's talk about something different. In your opinion, how are prices or portfolios being priced in today's market?
Very aggressively. You have a lot of the big guys that are in the space. It kind of reminds me similar to when I had really gotten the business right after the dot-com bust. All the Wall Streeters were really looking to, and investment funds, looking to deploy capital in other asset classes. We saw from 2000 to 2007, 2008, the prices on the same identical debt tripling. So I think that you have a lot of people entering the space, a lot of well-capitalized people. The time horizons are a little longer. I think the strategies are better, more tried and true now that a lot of groups have not just been around for 2 years, but they've been around for 20 years. So I see that the pricing is at an all-time high. We're at the same levels that we got to before. However, I think that with more and more competition, the expenses to actually collect the same account has been dramatically reduced. I think that comes through from mainly telephony to data mining, cost for your long-distance lines, the cost to do your scrubs, the cost to just outsource and find new groups, whether they're nearshore or offshore. I think that has actually gotten much better over the last 10 years. So although you might be paying what would seem to be a premium compared to 10 or 12 years ago. I actually think your expenses, if you do it properly, should be substantially less. So I think the returns could be the same or better, depending on how tight of a ship you run and how good you are in your due diligence and your gratification and how you're sending your accounts out to your recovery floor or recovery network or downstream buyers. Better you do at sourcing deals, and the better that can actually take that specific deal and disseminate it to your entire network through all your strategies, you're going to get a return at least as good as you had gotten back in the heyday in the mid to late 2000s if you do it right.
It's interesting if you think about it, right? Buyer has access to capital and they take down a portfolio at a higher valuation than maybe they would perceive it being worth. If they are able to really service the portfolio effectively, their returns could be significantly higher. So it's not, I think what you're saying is, while the purchase price is always very front and center and paramount, something everybody considers, part of your analysis also has to be on the recovery side, and certainly switching up your approach may make sense, whether or not you sue, whether or not you service, how you service the account, because the returns could be significantly higher, as you said, because of the advent of technology, the ability to communicate better with the consumer, be able to work through the accounts more effectively. So people do get lost in the purchase price. I think the purchase price is extremely important, but it's not the only factor in a buy or a pass situation. Like, as we wrap this up, for me, I want to say that I don't think we've seen a window like this since the heydays of the mid to late 90s into 2000, the early 2000s. We saw public offerings for debt buyers very strongly received, mergers and acquisition activity in that marketplace. Yeah, we saw some bad apples also. CFS, for example, and the blow-up of CFS, very, very prominent example. But in today's marketplace, I think because, as you said, I'll end with what you started with, I think compliance is actually a good thing. It weeds out the bad apples, but also it's created a forum right now where creditors and debt buyers, collection agencies, collection law firms, technology vendors can collaborate, do a nice job on these portfolios where really everybody can benefit from that. And the economy has a large part to do with this, but the increase in the amount of availability that we're going to start to see if we're not already seeing in the marketplace. So I think the window is wide open right now. Mike, is there anything that you want to say or anything you want to impart as a kind of a parting shot here as we wrap up this podcast?
I wholeheartedly agree with you. I think that, the window now is great for all of those reasons. For those of listening that are thinking about getting into debt buying, or you're an agency and you have not yet purchased, any type of debt, just make sure that when you start the process, you do it the right way, you get all of the adequate licensing you need, you get the insurance. Very good idea to become members of really good trade organizations like the ACA and pretty much stay in tune, stay up to date on all the laws. They are changing on a daily basis. Thanks a lot to you, Mike, and the ACA for having me on the podcast today.
Well, thank you, Mike, and thank you, Alex and Kim, once again for moderating this or putting this together for us. We appreciate it.
All right. Well, thank you so much to both of you. We do appreciate any time we can get additional information from members and experts in industry. So before I close, I'd like to remind everyone that news and information related to the accounts receivable management industry is covered extensively in Collector Magazine and in ACA's daily electronic newsletter. Both are available on our website at www.acainternational.org. This podcast and ACA's other podcasts are available on our website or wherever you normally listen to podcasts. Thank you and have a good day.